So if you're buying a house, there's a good chance you're going to get a mortgage. So what we're going to be talking about today is the types of different mortgages. So here's Guy Borg from the Royal Bank to discuss this a little bit more in details.
Thank you, Jean. So today I'm going to talk to you about some more language that you're going to hear when looking up information on residential mortgages. There's three different types of mortgages. There's a high ratio mortgage, a conventional mortgage, and a home line plan mortgage. First, the high ratio mortgage. Basically what a high ratio mortgage is a mortgage that has to be approved not only by the Royal Bank, but also has to be approved by CMHC, Canada Mortgage Housing Corporation, federal government. Those are mortgages where the down payment is less than 20%. So you're putting in less than 20% of your own money in the purchase of that home. The bank is financing 80% or higher. So when you do a high ratio mortgage, basically the bank gets an insurance policy against the balance of the mortgage so that if that mortgage goes in default, the federal government will repay the bank. In return for that, you have to pay a premium. So the consumer has to pay a premium based on the outstanding amount of the mortgage. So for example, if you get 10% down, or you put 10% down on your new home purchase, the CMHC premium is 2% of the total amount of the mortgage. The bank will pay that for you on closing and add it to your mortgage, and then you pay us back through the mortgage. That's a high ratio mortgage. Second type of mortgage is a conventional mortgage. That's when you have 20% or more of your money going into the purchase of the home. Flexibility, less risk. So we can go up to a 30-year amortization. You don't have to pay that premium. What you borrow is what you borrow. And it's basically approved only by the Royal Bank. We do not have to go to the federal government. We don't have to go to CMHC to get that mortgage approved because it's less risk. You're putting in more of your own money. You are more vested. Within the conventional mortgage, we have what's called an RBC home line plan. Basically what an RBC home line plan is, it's a combination of a mortgage and a secured line of credit to give you the flexibility of what you need in the future. It's access to cash. So in other words, if you put 20% of your money, we finance the other 80%, you can get an RBC home line plan, which is a combination of a mortgage with principal and interest payments and a secured line of credit, access to cash. As you pay your mortgage balance down, the amount you have available on your line of credit goes up, dollar for dollar. So eventually, once your mortgage is paid off, the entire amount is all in a secured line of credit. So it's basically access to cash. So if you have any other questions, you can give me a call anytime. It's guy.bork@rbc.com, 613-799-5199. Thanks.